Welcome to the B.F. Anderson Technical Report for October the 6th. I thought this was an interesting illustration, and it shows recessions. We're probably going to have a recession at some point. Now, we've got an inverted yield curve. Stock market's down 20 to 30%. Market may be pretty much discounting a recession. Well, over the last 150 years, things have dramatically changed. I think it's interesting. The author says here, the average time between recessions has grown from about 2 years, every 2 years in the late 1800s, to every 5 years in the 20th century, to 8 years over the half century. So what's causing this? In other words, if you go back and look, decades, a century ago, you see that the recessions were quite frequent and they were longer lasting. And since 1940, things have somewhat changed quite a bit. Now, why is this important? It's important because if you think about history and you go, okay, I want to look at economic history to try to see the future, well, things have changed. Back then, back in this period here where we had 2 world wars, also, this was more of a manufacturing, industrial type of economy, so it was more of a boom-bust type of economy, whereas now we're more into a service type of an economy, and so things really have actually gotten better. Recessions are just not as severe, but we're going to have them. There's no getting around it. Now, let's just kind of look at the past, going back to 1956. Most investors will make their greatest profits from a bear market. They simply don't know it yet. Bull markets are made from bear markets. So in other words, you have a bear market, then you have a bull market. You have a bear market, then you have a bull market. Now, is this time different? Well, we'll see. But if you look, you can just see here that there's definitely an economic cycle that takes place. So you have to really exercise caution in this period and then become aggressive in this period. And basically, the market right now is down, we're down in the NASDAQ's down approximately 30%. So you can see that, on the other side of this, we could have quite a nice recovery. Now, for reasons I have never understood, people like to hear that the world is going to hell. This is a historian, Deidre McCloskey. And the point is, look at the left to the right. I mean, this really has not been a bad deal. But there have been periods like right here where we had 2 bear markets, and it was quite difficult. I think one of the most important things to really notice right now is the pessimism. There is record level pessimism here. We have not seen this survey this pessimistic since back in 1990, around 1990. So the pessimism's even higher than the 08-09 financial crisis. It's higher than the dot-com bust. So what this means to me is you need to have your ears up because the masses are generally wrong. Now, I have mentioned in the past that the most important factors that you need to pay attention to is interest rates and corporate earnings. In fact, William O'Neill did a study. They went back approximately 100 years, and they found out that that earnings per share is the single most important element in stock selection today. So in other words, they went back and looked at all the variables that they could look at, and corporate earnings were incredibly important. Now, this is a graph of Nike. They announced earnings last week, and very disappointing. So we're seeing some disappointing economic numbers in the form of corporate earnings. Even Walmart, Target, Federal Express. We're having a tough time here. Now, on interest rates, I am very convinced that the stock market's going to have trouble launching a substantial rally until interest rates quit rising. Now, you can see here, I'll go all the way back to the beginning of this ETF, which is a high-yield corporate bond fund. This is a junk bond fund. Now, you can see here where the market, this is the S&P down here, the market and the junk bond funds or the junk bonds tend to bottom around the same time. And in fact, in this case, the junk bonds actually bottomed in advance of the stock market bottoming. So you can see here that right now today, we've really got a downtrending line here. This is not a positive situation. So I do believe that we've got a bull market coming, but this will be one of the ways that we'll be able to see it. Once this thing turns and we put a low in, I think the stock market will be able to move. Now, the other thing going on, we've had the last couple days, Friday and Monday were big up days. Now, we got what we call extremely oversold. This is percent of stocks on the NASDAQ above their 200-day moving average. Now you can see here we're getting quite oversold readings anytime we're down here below 25. So that right here, what that basically means that 90% of the stocks on the NASDAQ are below their 200-day moving average. So as a result, we got a rally and what we would call, I would just call a bounce on an oversold condition. Now let's just kind of look at a couple of the indexes. Here's the NASDAQ, continues in a downtrend. Now remember, the rule is we want to see the index actually get above the lower moving average and that lower moving average turn up. Well, that just hasn't happened, but you can see here, this is the rally we got for the last 2 days that kind of came off that bottom. So I don't think we're on a buy signal yet here. Now the S&P, same thing. I mean, we're in a downtrend. We're not above that lower moving average, so the downtrend continues. Now you can see it much more clearly here. This is the 200-day moving average. This is the S&P 500. You can see here back in the summer, we rallied up to that 200-day and it failed. So we're just not out of the woods yet. Aggression index, I am kind of seeing some optimism here. Now, remember with the aggression index, this is where we're comparing, it's a ratio where we're comparing technology stocks to consumer staples, things like Campbell's soup. So you can see here, back in, pre-pandemic, before the pandemic, you can see that, it came down and then we got back above that lower moving average, which is the 10 week. Stabilized, and then finally in March, April of 20, we took off. So what we want to see here is I believe we want to see some consolidation, want to see these moving averages kind of stabilize. That's going to be an important indicator to keep an eye on. Now on our 3 economic indicators, this is interest rates. We see a little bit of a back off in the 10-year Treasury. However, it did hit 4%. It'll be interesting to see if we can stay below that level. Now on oil, we've been in a downtrend on oil. We're getting somewhat of a bounce in here due to the OPEC announcement that they're going to reduce production. Now on the financial stocks, continue to downtrend, but we are getting somewhat of a small bounce. New lows, as we have noted in the last couple of weeks, we've been getting way too many new lows. However, we're seeing a contraction, only 78 the other day. So things on the new lows, we are seeing a little bit of a divergence there where as the market continues to have trouble, we're making fewer new lows, that is a positive. Now on trend strength, we continue to be at 0 on the NASDAQ. On trend strength for the S&P 500, we continue to be below 0, but you can see here we did get a bounce. Volatility index, the VIX. The VIX has gotten up here into the 30 area on a 5-day moving average basis. And, to get capitulation, I really think if we could get readings up here, that would be kind of interesting. Now, on the yield curve, we continue to see the yield curve in really kind of pretty nasty territory here. We're down around a minus 0.48. You can see that, here was a past recession. Here was a past recession. It just seems like to me we're awful deep into this, and we're also staying there. It's not like we're in and out. Now on the top 5 stocks that we're just kind of seeing in our database, this is Shockwave Medical. They really do have a fantastic invention, new technology for the treatment of calcium in arteries, and it's really an interesting company. However, the stock is somewhat in a downtrend. We got somewhat of a gap down. I would continue to watch. It's not a buy at this point. Akero Therapeutics, which is biotech. Big gap up on very heavy volume. I mean, it traded 50 million shares, normally trades 1.6 million. So big gap up, consolidated, and then basically it's breaking out again. So you might want to keep an eye on Akero. I'm not really familiar with the company yet. It's kind of small for me and kind of too risky, actually. Biogen, another biotech. You can see here, gap up. These were all mainly on trials. These drug companies have trials, and if it's leaking out that the trials are going well, the stock reacts. So you can see here, big gap up on Biogen. Actually didn't hold the gap, but it seems to be wanting to consolidate. Keep an eye on it. Consolidated Energy, which is coal. We're continuing to see the energy area kind of somewhat strong. Had a downtrend, kind of put in a little bit of a double bottom here, kind of a V formation, which can have a tendency to fail, so you want to just keep an eye on it. It has broken out above the 50 and the 10-day moving average. Here's First Solar. The solar stocks continue to act well. You know, you've got a real big move here, nice uptrend, kind of broke down a little bit and rallied recently, but pulling right back down into that base. Just continue to watch. I would not be aggressive here. So if you have any questions, please let me know. Main thing I would say at this point is just stay heavy in cash. Don't get too aggressive here. Let's wait for the tides to come in, which is our indicators getting above those lower moving averages. Thank you very much.